Let's move to our first conversation, where the International Monetary Fund and the World Bank Group have collaborated with the International Energy Agency to develop a unified response to the deepening energy and economic crisis from the ongoing war in the Middle East. Meanwhile, Nigeria's parliament has passed the 2026 budget, including the 9.3 trillion naira latest request by President Bola Tinubu, bringing the total figure to 68.3 trillion naira. Tilewa Adebajo, CEO of the CFG Advisory, joins me to discuss these developments. Thank you so much, Tilewa, for your time. But let's first of all look at the developments that have played out in the last 5 hours. President Donald Trump coming to say that they are going to continue the attacks in Iran, and this has stoked oil prices. We're seeing about 7% increase within the last hours. Now we're hitting the $100 mark again. How long can this foster?
Well, I think the most consistent thing about the United States president is his inconsistency. And anything he says, we need to take with a pinch of salt. He's using diplomacy as a dice for military preparation. I think that's quite obvious. And I think the statements by the World Bank, as you've said, the impact of this is going to be far-fetched, because it's going to take the world at least another quarter to 6 months to recover from this crisis. And I think the statement from the World Bank, I think, is obvious enough, because you've seen the fact that the key factors of production and the key inputs into supply chains and value chains have been impacted significantly. And the ripple effects, I think, we'll begin to see over the next couple of months as we begin to see the pass-throughs of the higher energy prices in all the economies of the world. And of course, we're looking at not only inflation, but if this continues at this rate, I think you can begin to see the threat of a global recession.
We're seeing the responses from the World Bank and the IMF, the global institutions. But let's look at how African institutions here can respond to this. We're seeing bilateral institutions and regional institutions also come up to see how they can provide the necessary shocks for African nations. We've not heard so much from them, but let's look at how this ripple effects will trickle down to policy decisions of African nations. We know in a couple of months' time we're going to see policy responses from central banks across Africa. Let's look particularly for SSA. What are the expectations?
Clearly, I mean, the overall impact of all these are cost-push inflationary effects, which will begin to manifest themselves very shortly. And you need to brace yourself up for that. In Nigeria, for instance, inflation, we've struggled with inflation over the last year and finally got inflation down to about 15% officially. And our monetary policy rates have still remained at 26.5%, which is still pretty high. So I think for a while, I think we might be able to, Nigeria might be able to survive for the next couple of quarters without an increase in the monetary policy rates. Because if you take a look at the impact of these oil prices on the food prices and the sort of cost push effects, you might see inflation maybe inch up back to about 20%. So that, that we need to monitor that carefully and see, because a lot of all these are lagging indicators. They're not leading indicators. So there's a lag effect. Probably will not begin to see that until a couple of months' time. But I think Nigeria is okay. So it's just a question of when the Monetary Policy Committee decides to maybe hike rates. But I think they need to hold rates now until we understand which direction this would go.
All right, let's move now to the fiscal side. We saw yesterday Parliament approve the President's additional about 10 trillion naira in terms of budget. Now we're seeing around 68 trillion naira in terms of budget. And then also they are looking to take advantage of the windfall from higher crude prices.
Well, let us be very clear on that now, very carefully, that Nigeria is not going to benefit 100% from the oil prices, because we have sold a lot of our crude oil forward. And I think that is really the disadvantage. I've been saying very carefully that the NNPC needs to refinance a lot of all these forward contracts and maybe go into a bond instrument, maybe a 5 to 7 year bond, in order to free up these barrels. Because if they had freed up these barrels now, then you can see the windfall. And this issue with the budget deficit, you can see that with the old budget at 58 trillion, the deficit was 25 trillion. Now, with this new budget at 68 trillion that you've added 10 trillion on top, we haven't seen, we have to look at the details, but from the Reuters report, we haven't seen the additional revenue. So what that means with this additional is that you are taking your deficit from 25 to 35 trillion. So I don't see where the government is going to finance 35 trillion, despite the fact that another loan of $6 billion was approved. $1 billion of those loans from Citibank is already committed to the port project, and the funds from the Abu Dhabi Bank, I'm not sure how that will be applied, but it cannot be applied to be able to resolve recurrent expenditure issues, or that would be a complete disaster. So the question now is that the government is now facing significant fiscal challenges in terms of how it's going to finance a 35 trillion naira deficit. So that remains to be seen.
All right, while we wrap this conversation, let's look at how, in terms of what the government is projecting, and then also the president is also going to make an approval. But in terms of debt servicing, which is a major issue compared to our revenue mobilization, let's look at how that discrepancy would cause another lag, and then also the government being able to consolidate other budgets like 2025 and 2024 budgets, which have not fully been utilized.
Well, from this budget now, all the other three concurrent budgets that we're running have been consolidated into this 2026 budget. That was the original plan, and that has been done. But the fact is that the government has consistently been unable to fund the capital expenditure component of its budgets. So the revenue challenges, despite the fact, don't forget that our taxes have increased. We've increased taxes by about 45%. There's going to be a 45% increase in tax collection projected from last year to this year. So despite or in spite of all these increases in revenues, removal of subsidy, which was supposed to deliver about $15 billion a year in savings, we're still running a deficit, which is a concern. So there's something amiss, and I think that we need to wait for the details of this budget to begin to get a better grasp an understanding of what's going on with this budget. But there's really something amiss, because 35 trillion deficit is a significant red flag, because this deficit can threaten the gains of the reforms.
Well, a real red flag. We'll wait to see how when the budget office is able to provide the necessary details regarding how the breakdown of the budget is. Thank you so much for your time, Tilewa.
Thank you, Aki.
I've been speaking with Tilewa Adebajo, CEO of the CFG Advisory